Hello and welcome back to the Good Money Guide podcast with me, Michael Hewson, and my guest, Michael Brown of Pepperstone, where we look back on all matters financial markets over the course of the past few days and also look ahead to the events coming up. And obviously next week is going to be a fairly short week. It's US Thanksgiving. So I think once we get past the Wednesday, you'll find that trading activity starts to dry up to a certain extent. So, I think in the context of we may not have an awful lot to talk about next week, but there's certainly plenty of things to talk about this week. Before I get started and jump into it, obviously I have to do the customary risk warning, which I'll read. I should know it off by heart now, but it has to be word perfect, as I'm sure Michael is only too aware when he deals with his compliance department. So here we go. The information provided here, whether from a third party or not, isn't to be considered as a recommendation or an offer to buy or sell, or the solicitation of an offer to buy or sell any security, financial product or instrument, or to participate in any particular trading strategy. We advise any readers, viewers or listeners of this content to seek their own advice. Spread bets and CFDs are complex instruments and come with a high risk of losing money rapidly due to leverage. 75.1% of retail investors lose money when trading spread bets and CFDs with this provider. Okay, so going to be slightly different this week. We're going to start with a couple of pieces that are on the news and views section of the Good Money Guide website. Written by one of our Good Money Guide columnists, Robin Amos. He looks at the world's wealthiest investors and how they made their money. And let's be honest, who doesn't look at some of the biggest investors and traders out there and wonder, I think, at some point how these people made their money and how they've managed to survive essentially in what is a very, very competitive world and a very competitive landscape. Not surprisingly, Warren Buffett is top of Robin's list. And essentially, why wouldn't he be? I mean, he's been around 70 years. He's almost the trailblazer when it comes to value investing. And his track record is essentially second to none. His durability really, I think, is testament to the fact that he's been able to adapt to different trends across multiple decades and continue to come out on top. And through his investment vehicle, Berkshire Hathaway, continues to, I think, set the standard, the gold standard, if you like, when it comes to investing in companies that potentially an awful lot of people would probably think twice about investing in. But his mantra has always been buy when others are fearful. There are a number of other companies and individuals on that list, and I'm sure Michael's got his own take on a couple of them. I think one of them did catch your eye, didn't it, Michael, at number 5?
It did, mate. I mean, I was going to say, firstly, good afternoon. Also, it's remarkable. Warren Buffett's been in the market, longer than you, which is a rare thing, these days. But
I
I'll
know, I don't
leave it
think
there.
I'm going to be working when I'm his age.
Well, you never know, mate. You never know. This podcast could take off one day.
Well,
I think, yeah, number 5 is an interesting one for me. I think it's a slightly contentious one. Changpeng Zhao, known as CZ or CZ for our American listeners, of course. I'm not convinced that I would put in any position on a top 10 list, let alone at number 5, someone who is under God knows how many charges for various violations and breaches of US security laws. Yes, I mean, he's made a hell of a lot of money, but I don't think he made that money in perhaps quite the most legitimate way, running
we
Binance, of
need to
course.
be very careful, I think, here when we sort of speculate on how he made it. I mean, on this list here, $57.3 billion. To those of you who don't know, he's essentially made his money through Binance,
Mm,
the crypto exchange. And on the subject of crypto, Bitcoin's approaching $100,000.
it
And
is.
there's a nice article also on the Good Money Guide website about whether or not we'll hit $100,000 by the end of the year. I would argue we could hit
End
it
of
by
the
the end of the
week, the way
week.
things are going. Yeah, exactly. That does seem like it's a bit of an inevitability at this point. Although, yeah, I mean, I'm no great sort of fan of crypto, but I would say just with any market or any asset, when everyone is kind of gunning for the same target, you do question: are we just going to sort of kiss 100 grand and then see a hell of a lot of participants take profit and a few orders hit at that level? So it's certainly on the radar, and it feels like a matter of days until we do break that barrier. I guess the question is, do we break it and blast through, or do we break it
Mm.
and actually that marks a bit of a near-term top and the end of some of the bullish momentum we've seen recently?
Yeah, I mean, and I think one of the reasons for the bullish momentum, I think there's also a lot of speculation that President Trump will look favourably on crypto. He
Mm.
certainly in his run up on his presidential campaign, he was talking about creating a Bitcoin reserve
Yep.
uh, within the US Treasury, and I think there's an awful lot of hot money flowing into it because of that. We've gone slightly off topic there. Let's try and move back to the actual topic in question. Number 6 has caught my eye, Masayoshi Son, who's SoftBank, um, has a stake in Arm Holdings. He's had quite a yo-yo journey when it comes to
Mm.
his net worth over the years, because obviously when Arm was basically sold off, and then SoftBank took a massive hit, I think in around about 2019, 2020, I think,
Yeah, it
and
was. It
he
was
saw
certainly
his net
before
worth
COVID.
really crater.
Yeah, it was certainly before COVID, and without wishing to veer off topic once again, I mean, SoftBank are one of those vehicles where they're either having an incredibly good time or an
Mm,
incredibly poor time, and there doesn't seem to be a lot of in between. But I think Arm Holdings, I mean, obviously they've now done that IPO in the US. That was one that could have come to London, and again speaks to the unattractiveness of the London market that
mm.
they decided not to list here.
But you look at the valuations that you can get in the US compared to
Mm,
London, and I can really understand why. Because when I look at
absolutely.
some of the London shares or the London, some of the shares on the London Exchange, they are criminally undervalued. And I
Yep.
think, if they were listed on the listed in the US, they probably worth 2, 3, 4 times
Hmm.
as much as they are here. And I think that, it's absolutely criminal that we place so many obstacles in the way of people looking to invest in the London market. There needs to be a happy medium between over-regulation
Hmm.
and under-regulation.
Yeah.
And you look at the growth of the US market since 2010, and then compare it to, the example, the UK market. There is no comparison at all.
No, absolutely not. We've gone off topic again, haven't we?
We have. So I'm going.
Because I
I'm
know
going through.
there's a
I'm
couple
going.
that you wanted to add to the list, aren't there?
Yes, there are. I mean, I'm going through this list, and I've got to say, a couple of them, I've never heard of, which is surprising. But then, when you consider that, the ones that you have heard of, say, for example, like Larry Fink,
Hmm.
BlackRock, again, and you look at their net worth, they don't even come anywhere close. And then you've got Bill Ackman, Pershing Group, who's got a listing on the FTSE, on the London, on the
Hmm.
London Stock Exchange. Again, they
I
don't come
mean,
anywhere close. But you're right.
let's stress neither of those are particularly hard up for a few bob. They just don't
No, they're
quite
not.
make the cut for the top 10.
No, exactly. And they just about make it into sort of 10 or 11 billion dollar
Oh,
territory,
is
as
that
opposed
all?
to these people who are worth 27, 28, 29, 30, 40,
Hmm.
50 billion dollars. But you're right. There is one person on that list. Sorry, who should be on that list, in my opinion, who isn't. And he's probably going to be a slightly controversial pick. But I don't, I think he should be on that list. And the man's name is Elon Musk. He
Hmm.
should be on that list, in my opinion, because he's worth $300 billion. Yes, we know him from Tesla, obviously, and we also know him from SpaceX. But those of you who've been in the market long enough who know his backstory know that he was an early investor in PayPal. He founded X.com in 1999, which was a direct bank, which then merged with Confinity in 2000 to form PayPal. Now, he sold his stake in PayPal to eBay in 2002, and with that money, he formed SpaceX and was also an early investor in Tesla in 2004. He didn't stop there. He then helped create Solar City, an energy company, which Tesla bought in 2016 and then became Tesla Energy. So in addition to that, Musk has also in the last 10 years co-founded OpenAI. Yeah, he fell out with Sam Altman, but that's pretty much well documented. He then set up his own company after quitting OpenAI called XAI. But more than that, he also formed the Boring Company, which isn't boring. It's a boring company. It's a tunneling company.
Yes.
And he's also formed Neuralink as well. So he's formed an awful lot of new ventures over the course of the past few years, created thousands of new jobs. And like him or hate him, you can't ignore him.
No, absolutely.
So in my opinion, he should be on that list.
Yeah, I think you're absolutely spot on. I mean, set aside the politics and the way, people act and all the rest of it, he is clearly an incredibly intelligent, incredibly driven, incredibly successful entrepreneur and investor. And I would sort of second your nomination, so to speak. I think he absolutely deserves his place on that list. Probably would even deserve his place on that list for one of those companies, let alone the 8 or 9 that he's actually ideas that he's taken from, seed to all the way to, some of the biggest businesses in the world and still growing even to this day.
Absolutely. So, I mean, probably draw a line under that, and I'll probably get, a rather, I don't know, may get an email from Robin to say, well, yeah, maybe that's a good point, or maybe it isn't. Don't know. But if you want to read this, it's on the Good Money Guide news page, the world's wealthiest investors and how they made their money. It's up there, top 10. In my opinion, it should be a top 11, behind Warren Buffett, because I think Warren Buffett is a daddy, as far as I'm concerned, because of his durability and his longevity. But I certainly think Musk should be in that top 10.
There, and I know he is sadly no longer with us, but Warren Buffett's right-hand man, Charlie Munger. Because I think Buffett himself has actually said that a lot of what he has done, he wouldn't have been able to do without Charlie Munger as his number 2 at Berkshire Hathaway. So, maybe they should be a sort of joint first.
I would certainly echo that, because you're absolutely right. Warren Buffett did actually say that. Without Charlie Munger, he wouldn't have been anywhere near as successful as he is. So, absolutely, 100% would agree with you on that one. Another thing, moving swiftly on, there's a decent piece by my colleague Darren Sinden on Microsoft. This underdog from the Magnificent Seven could be the surprise winner in 2025. Now, he's argued, and it's a very persuasive argument, that over the course of the past 11 months, Microsoft, of the Magnificent Seven, hasn't performed anywhere near as well as the other 6. And when I look at the chart that I've overlaid of the Magnificent Seven in front of me, he's absolutely right. Nvidia is the daddy this year. Obviously, we'll talk a little bit about Nvidia's results later, because they were very good. But overall, you look at Microsoft's numbers this year, and Darren has argued that there's potential for an awful lot of growth in the cloud division, Azure. But I would also argue that, yes, Microsoft has underperformed this year, no doubt about that. But I think there's also a danger that you can look at it on too narrow a basis. If you actually go back to 2019, Microsoft was at $100. 2019, it's now over 400. So sometimes when you look at a 10-month period in isolation, it does look as if it's underperformed. But actually, when you zoom out a little bit further, actually, it's not done too badly. They are returning capital to shareholders. Their margins are very, very good compared to their peers. But the cloud, just focusing on cloud, it's a very competitive space. You've got.
Yeah, I mean, well, I was going to say, I think firstly, you can't complain about a $300 rally in the space of 2 or 3 years. I think it shows the importance of zooming out. Yes, they've lagged peers, but there are a hell of a lot of peers in this space now.
Mm.
Microsoft have got cloud, Amazon, Alphabet, of course. They're all trying to sort of muscle in on each other's territory, and of course this
And you've
comes
got
at
Snowflake. You've got smaller players.
yeah, of course, Snowflake. There's a few others in there as well, and of course, this comes at a time when competition is increasing, and I think from the corporate side, from the client side, if effectively, the view is shifting. It's not just a case of this has cloud in it, this has AI in it, so we're going to buy it now. I think the view is now much more a case of what's this going to do for us, and what is the payback time going to be from this. So I think it's not, in a way, perhaps the easy money from the cloud businesses side, the easy money's probably been made. We've slapped a label that says cloud on something and everyone's bought it. The question now is where do we go next? And I think that's when you have a real kind of arms race between all these players as to, who's the quickest, who's got the most capacity, who's the most secure, etc., etc., etc. And that's the stage of this that we're now kind of slowly but surely migrating to.
Mm. I think to focus, as you say, on the cloud, it's a little bit one-dimensional. I'm just looking at the segment breakdown for Microsoft's Q1 numbers, which came out at the beginning of this month, the end of last month. It was interesting to see that percentage change year on year. Cloud actually wasn't the best performing sector, or Azure
Oh,
wasn't the best performing sector. Do
what
you know what
was, dare
was?
I ask? Go on.
Xbox.
Ah, that's because you've
Xbox.
now got more time to play on your Xbox that's behind you.
Yeah, well, I prefer PlayStation to be fair, but yeah, I mean, I've got both, but yeah, I mean, Xbox content and services, 61% change year on year on a gap basis on Q1. Azure and other cloud services was 33, and then basically you then had server products and cloud services, which was a 23% percentage change year on year. So I think the good thing about Microsoft is it has a diverse product mix,
Hmm.
and I think that will help because if there's a slowdown in one area, then hopefully an acceleration in another area will offset any weakness in, a particular segment, if you like.
Yeah. And of course, coming into, you alluded earlier, Thanksgiving and then Christmas very
Mm.
shortly after that, is that going to be a bit of a boost to the Xbox and the gaming sector once again in
Mm.
the fourth quarter figures?
I think it helps when they have, sort of big games getting launched. And obviously, one of the big games that has been launched quite recently has been the new Call of Duty.
Hmm.
So that could actually boost um, uh, the sale of consoles as well as games, as we said, heading into Thanksgiving
Yeah.
and Christmas. Going to finish up with a piece by Ed Sheldon. Can the S4 Capital share price bounce back? Now, for those of you who don't know, S4 Capital was formed by Martin Sorrell when he parted company with WPP, but's had a really rocky time of it since 2021, lost 95% of its value, taken a massive hit in terms of trying to generate any significant share price gains, has seen a bit of a bounce back today, announced some numbers earlier this month, showed a 15% decline in revenue. But I think there comes a time is when a share price is this battered down, how much more downside is
Hmm.
left. It's got a fairly decent client catalogue. It's got clients like Amazon, Netflix, Diageo, Marriott, TikTok, Google, or Alphabet. But at the moment, it's struggling. And when you compare it to WPP and you compare it to Omnicom Group, who are both big marketing companies, it has underperformed. But just because, as you said last week, just because the share price has fallen quite precipitously doesn't necessarily mean it's ripe for a bounce back.
There you go. I do say some, sort of sage things every now and again. It's just as well
And
we
I remember
record
them.
this. Yeah, there you go. At least someone does.
Mm.
Because I didn't remember I said that. But you are absolutely spot on. Just because something's come a long way down, it doesn't mean that we're, ripe to rally. It says in the piece here that, we're 95% below the highs that we saw about 3.5 years ago. That is a huge decline, but the stock needs a catalyst to rebound. That's not
Mm.
to, at the same time, you could also argue a hell of a lot of bad news is priced in. We've come a long way lower. There might not be much more scope for downside, But that's not to say that S4 Capital can't just bump along the bottom for the next 6 to 12 months, because
Mm.
the market is not going to buy in with conviction unless we see a reason to do so.
It needs to show evidence of revenue growth,
Mm,
and marketing spends on behalf of companies can be very fickle. And
mm,
we're currently in an economic environment here in the UK that is very well. It's starting to look a little bit tricky, shall we
mm,
say, given the backdrop for business more broadly. I think the increased costs that are being heaped on businesses by the current government. This morning, we saw public sector borrowing for October hit the second ever highest October figure ever because of the recent public sector pay rises awarded by the new administration.
mm-hmm.
We've had farmers protesting in the streets this week. We've got retail sales due on Friday. Now, hopefully, they won't show too dark a picture. But I've got to say, I think if you're a business and you're looking at growing the business, you need certainty about the
Mm,
economic environment. You need certainty about your costs.
yeah.
You need certainty about the economic outlook. And we're not really getting any of that at the moment.
No, not at all. And of course, the other thing that we've had this week is the latest inflation data. And, headline inflation did tick higher. We knew it was going to, up to 2.3% on an annual basis in October. But again, it's the core, this is something you mentioned last week. It's the core inflation and the services inflation, which remains sticky. It remains elevated, and it's continuing to point towards price pressures remaining persistent within the economy. Core CPI at 3.3% in October, services CPI at 5% on an annual basis in October. The services CPI has been at or about 5% since the middle of 2022 now. And the core number, yes, it's come down, but it hasn't got below 3%, convincingly yet. And I think, you start to look at the UK economy and you say the labour market is loosening quite significantly. Inflation is not over as an issue. The cost to businesses of doing business, employing people, and just generally doing business in the UK is rising substantially, and consumers are likely to start tightening their belts. Oh, and government borrowing is going through the roof as well. I mean, I'm not the most optimistic chap at the best of times, but I can't really see much reason for particular optimism at the minute.
No, and I think, it's all well and good to have, an optimistic outlook, but there's a fine line between an optimistic outlook and rose-tinted glasses. I
Mm,
think there needs to be, yeah, I'm the government's probably one of the government's biggest critics, but this is not party political for me.
no.
I thought the last government were a bunch of amateurs, the way they managed the economy. Unfortunately, this lot are making them look like professionals.
Well, yeah, exactly.
And I think that's a horribly low bar to
Yeah,
actually fail to overcome.
yeah.
Uh,
And I don't think either of us take any particular joy in this. We want
no,
to see the
no.
country do well. We want to see the economy remain resilient. We want to see, strong economic growth, but it's just not happening at the moment.
And I think when you've got small businesses as well, I mean, and let's not forget these inheritance tax changes don't just affect farmers. And I think one of the things that's been overlooked in all the outcry about this inheritance tax thing is this also applies to small businesses as well. So if you're a
Hmm.
small business that's been running for, 50, 60, 70, 80 years, and you want to pass that business on to your son, daughter, or someone in your family, whereas beforehand you weren't subject to inheritance tax, now in some
You are.
cases you will be.
Yeah.
So what does that mean for the thousands of small businesses that essentially are here in the UK?
Mhm.
If the founder of that small business or the owner of that small business wants to step down and pass it on. You know, Historically, the UK has been a nation of small shopkeepers, right?
Yeah, absolutely.
You
And
don't want to dilute that spirit, and it's essentially what
no,
this government is doing.
yeah, and of course the other thing that's really gone under the radar is that the threshold is likely to remain frozen for quite some time. So you think about
Yeah,
inheritance tax now, 325 grand is the basic threshold
since
of anyone can inherit.
2009.
2009 exactly, and it's going to be frozen until 2028 if that doesn't get rolled forward because a chancellor in the future wants more headroom. So everyone going, farms under £1 million are not going to be subject to this, etc., etc., etc. Yeah, farms under £1 million now. What happens in 2, 3, 5, 10 years when the threshold is still
Fiscal
£1 million?
drag.
Exactly. Nobody is
Fiscal
accounting for
drag.
that whatsoever.
No.
So yeah, again, it's another, and that applies to small businesses too, of course. And it's another example of a sort of anti-business, anti-growth policy, effectively.
No. No. Okay, well, now that we've chewed the fat on that, Michael, here ends this episode of Two Michaels Moaning. Well,
Our special guest Victor Meldrew will be joining us
yeah,
next week for Thanksgiving celebrations.
exactly. He's not available. Uh, he's the optimist of the group.
Well, yeah,
Um,
out of us three.
yeah. Okay. So on that note, let's look back at the numbers that we previewed last week. So we had Walmart, we talked about Target, we talked about Nvidia, but let's look at it domestically first. Let's look at JD Sports. Now, obviously, an awful lot of retailers have gone on the record as saying that these changes in certainly national insurance rates, as well as business rates and what have you, they're very negative. And there's been plenty of column inches, not only in the FT, but pretty much across all the big broadsheets, the Telegraph, the Times, saying that businesses are really disappointed in what this government was saying in the lead up to the election and what they're currently delivering. JD Sports shares, they got off to a bad start to the year after issuing a profit warning. They're down again today, 15%, no, 16% now, on the back of another disappointing quarter, third quarter. I'm looking at the numbers now, and I'm looking at the like-for-like sales for Q3, UK Q3 like-for-like sales, 2.4% decline. In North America, they were down 1.5% decline, but they put that down to uncertainty ahead of the US election. On a year-to-date basis, UK like-for-like sales are down 2.7%. North America, they're up 1.8%. Europe, they're up 2.7%. This is year-to-date. They are spending a lot of money. They've obviously taken over a bunch of a couple of retailers. The US retailer Hibbett, which should contribute around 25 million to profit before tax at current exchange rates. But they've lowered their guidance for profit before tax and adjusted items to the lower end of the guidance of 955 million to 1.03 billion pounds. Market doesn't like that, and it's basically dropped really sharply. I'm looking at the chart now, and it's back down at levels last seen October last year. So hopefully they won't take out those October lows. I'm sorry, not last year, October 2022. So dropped to 2-year lows. So it looks to me as if the shares are going to start the year badly and then finish the year badly.
Yeah, it certainly looks that way. I think there's two sort of main takeaways from this for me. One is it's a classic case of, from a market perspective, probably about as bad an earnings report as you can get, where you miss expectations and come in on the soft end of guidance. There is literally nothing for the market to like. But then from a sort of broader macroeconomic point of view, I think actually some of the commentary was interesting around, the fact that consumers do appear to be tightening their belts and actually prioritizing spend on areas away from sportswear and athletics and all that kind of thing. And I think then you start to go, actually there's a few takeaways. One is, obviously it's bad for JD Sports. Two, what does it mean for their competitors? I can't imagine that Mr. Mike Ashley would have been sat there looking at these results with a smile on his face, because his group are probably experiencing similar issues. And then going back to the retail sales figures that you alluded to that we've got due Friday morning, which will probably be out by the time you listen to this. Again, you're looking at consumers that are not looking to spend quite as much at the moment. And that speaks to a more anemic pace of economic growth going forward.
I mean, I will say Fraser's group, Mike Ashley's, sort of conglomeration of various different companies. They're due to
Half
report
the
at the
high
beginning of
street.
December. Hmm?
Half the high street that he owns now.
Well, yeah, pretty much. I mean, he's got obviously Fraser's Group, House of Fraser,
Hmm.
Sports Direct. He's got stakes in Hugo Boss,
Yeah.
Boohoo. I think he's looking to um, try and increase his stake in, or try and get a stake in.
Mm.
There was some chatter on the wires this morning about he was having a bit of a disagreement with the management there. But yeah, I mean, he wants to be the new king of the high street. But at the
Yeah.
moment, the way the high street is going, I think the high street's probably going to be an awful lot smaller in
Mm.
terms of the size of the sector than it was, say, 3 or 4 years ago. But they're due to report at the beginning of December, so it'll be interesting to see what they've got to say
Mm.
when it comes to the overall retail outlook as we head into next year.
Indeed. And I'm
On the
sure we
other
will
side,
cover that at the time.
we will cover that at the time. Yeah, we'll talk about that at the time. Over the other side of the Atlantic, it's a slightly different picture, no less challenging, mind you. But we talked about Walmart and we talked about Target or Target. I'm going to say it again. Um, you still don't believe me about that, do you?
I really don't.
Anyway, Walmart blew out the lights, shot out the lights with their numbers. Um, they didn't disappoint. Not for nothing are they the US's number one retailer. Just a quick précis here. A 5.5% increase in revenues to $169.6 billion and earnings per share of 58 cents a share, a 13.7% increase on the same period last year, sending shares up to new fresh record highs. So Walmart continues to shoot the lights out. Unfortunately, Target continues to disappoint because their numbers prompted a significant sell-off in the share price. And I thought it's a sort of indication of if you get the balance of the mix right when it comes to digital collection and essentially in-store shopping and the broad supermarket experience, if you get it right, you can
Mm.
really reap the dividends, you can really reap the benefits. You get it wrong, and the market can be incredibly unforgiving.
Yeah, very much so. I thought one of the interesting things with the Target earnings was, not just the earnings, which were clearly soft, but also the guidance, because they actually raised their guidance when they reported earnings during the summer, and then
Mm.
3 months
And they
later
cut it
they've
again.
slashed their guidance again. So,
Yeah.
I think that's one of the reasons why the market took those results so badly, is
Mm.
because you've just raised expectations and now you're completely slashing expectations again. But
Mm.
as you say, it is interesting, that divergence that we see between the two. And I guess, it's a really key period for Walmart, Target, and all retailers now going into what is probably the most important 6 weeks of their year.
And I think it also speaks to sometimes management need to manage market expectations when it comes
Yes.
to offering guidance, because you rightly pointed out that in Q2 they raised the lower end of their annual profit forecast to $9 a share. So markets latched onto that,
Mm.
and obviously that helps support the share price. But now they've slashed it to between $8.30 to $8.90. So they really didn't think that through when it came to lowering the bottom end
Yeah.
of their guidance, and didn't think far enough ahead. And sometimes I think there's a lesson there in expectations management when it comes to sort of speaking to shareholders. What was
Mm.
also interesting though, and I think this is important, we're not entirely comparing like with like here. Yes, Target
No,
does
that's
sell
very true.
food. Target does sell food, right? But the food sales are a much lower percentage of its footprint
Yeah.
compared to Walmart. Target sales of food are 23%. Walmart is 60.
Yeah.
So there, I think, probably lies some of the challenges that Target are facing. Maybe they need to do something similar to what Marks and Spencers have done here in the UK and focus on a food offering,
Mm.
hopefully make sure it's a good one,
Well,
And no one has ever said that
tends to
Marks and
help.
Spencer's food offering is not good. It is.
Mm.
And essentially try and get that mix more in balance.
Yeah, and I think that's a very important distinction to make. They are, they're both retailers, but that's kind of where the similarities end.
Mm.
And I think also it speaks to, consumers need staples. You'd be
Yeah.
very hungry very quickly if you didn't buy food.
Mm.
Consumers can go without some of the big box items. If you've got a
Mm.
television, do you really need a new one if times are
Mm.
getting a little bit tougher than you expected? Probably not. And I think that's kind of the situation that we're seeing with Target. So perhaps speaks to a little bit of underlying softness in consumer demand for some of those more discretionary products.
Indeed. And the thing is, I think most consumers generally tend to be by definition slightly lazy. They want to do their shop all at
Yeah.
once. So if Target targets food, then,
I've
then
been trying to avoid the obvious pun
I
the whole
know, I
time, and
know.
now you've
Well,
gone down that route.
I called you out on that on Twitter earlier this week.
You did, you
So
did.
predictable. So predictable.
Oh well, I'd
So
hate to
predictable.
disappoint.
No, well, you never disappoint, Michael. Um, anyway, so which leads us, I think it basically takes us neatly into Nvidia, the
Yes.
daddy, the daddy of the tech this year. The bar was already high leading up to last night's numbers. The market reaction, I think, was significantly, I think it was significant because when the numbers came out, the shares sold off,
Mm.
despite the fact that Q3 revenues beat expectations by a distance. I mean, they really did. The expectation, let me just remind you, $32.5 billion was what the market was expecting. We got $35.1 billion. So more than a significant beat. Also, profits. And again, it was, profits better than expected as well. Data center revenue was the key driver of that
Yeah.
revenue beat. 94% increase from the same quarter last year. Not only that, it was a much, we were talking about a $6.5 billion increase. Okay, it was nearly $10
Yeah.
billion increase in Q2.
Yeah.
Markets didn't really like it. Looking at Nvidia shares now, they're now down 1.3%.
Well,
And
that's okay because they were down as much as 5% about 9:30 last night in post-market
yeah, but they
trading as
opened
those results
1.4%
dropped.
up.
Yeah.
So,
Yeah, I think the market's having trouble digesting it. I mean, you look
mm,
at the numbers and, well, I was going to say they're good. I mean, quite frankly, they are staggering for a
yeah, they're
company
brilliant.
as big as Nvidia, with a $3 trillion market cap, or
Mm,
maybe slightly less than that now, given the move that we've seen today. One of the top 10 biggest companies in the world to deliver this amount of growth on such a consistent basis is astonishing. I don't think anyone's seen anything like it. I think there's a couple of things that I would pick out from the numbers. I think the first is that, you know, because everyone is expecting such a ridiculous pace of growth from Nvidia, when they deliver it, there's kind of a collective, oh, is that it? Whereas when you take a step back and you go, you're doing triple digit revenue growth on an annual
mm.
basis, it's ridiculous.
But
But
it's
the
not
market's
sustainable.
well, yeah, firstly, it's not sustainable. And secondly, the market's bar is so high that almost Nvidia is never going to meet it. I
Mm,
think the other thing that is perhaps starting to become a little bit concerning is that, in the guidance, Nvidia was saying that demand will outstrip supply for the Blackwell chips for the
mm,
next 12 months at the very least. And I think this is, something that the participants are probably getting a little bit concerned about. Firstly, because you're going, well, actually, are Nvidia going to do anything about this to try and get, remove some of these production backlogs? And I think, secondly, the AI arms race, which is effectively what it is. You've got Intel, you've got AMD, you've got all these other people trying to make what
mm.
Nvidia are doing. Huawei in China, of course, Bloomberg was saying they were struggling earlier in the week. The market's kind of going, well, actually, the longer we go on where demand is outstripping supply, yeah, that's great from a perspective of you're going to keep delivering revenues, but it also means that other people can catch up.
Mm.
and there is going to come a time when people will catch up. And if, let's say, Intel, for example, come out with a chip that can do exactly what an Nvidia chip can do, and Intel can deliver it to your door the next day, rather than you waiting for 12 months for Nvidia to make the same thing, who are you going to buy from? And I think that's something that is kind of increasingly playing on, market participants' minds.
Yeah, I mean, I think one of the things Nvidia said about Q4 was that it expects to see a modest increase on Q3 revenues to $37.5 billion. I
Hmm.
mean, $37.5 billion, that's a decent, that's a decent number. But I think the market was expecting, I think Goldman's was expecting $39 billion.
Yeah.
dollars. So I think that's probably why you're seeing a little bit of softness. I think there's also that story out earlier this week about overheating
Hmm.
issues. The Blackwell GPUs were suffering
Yeah.
overheating issues in some data centers. Obviously, that's a problem they need to get on top of, in addition to the production backlogs and what have you, because the last thing you want is a chip that's overheating. But I mean, you know as well as I do, that chipsets, whether they be in laptops or whatever, they run hot. You need fans for them. These Blackwell GPUs are reported to be 30 times faster than the preceding models.
Yeah.
Well, that's a hell of a lot of heat.
Yeah, exactly that. And it's one of those things where, again, it's just Nvidia's gone from being all good news to now
Mm.
there being one or two little spots of slightly more negative news around the stock. And I think that's something that the market just needs a little bit of time to get its head around. It's no longer this, perfect nirvana of a company. Like everyone else, there are some little foibles and some little issues that need to be ironed out there.
So a bit of a pause, I think, is probably um,
Yeah, I
the
mean,
principle.
I haven't got my Bloomberg open in front of me, but Nvidia's up by what over the last 2 or 3 years? I mean, we're talking triple-digit percent easily, if not more, I would imagine.
Yeah, we talked about it last week. It's gone from
Yeah,
$40 to $140. So,
yeah.
not
Uh,
too
uh,
shabby.
no, and again, it's come a long way in a short space of time.
Yeah,
It can't, nothing can go up in a straight line forever.
yeah. I think we've seen the easy wins. I mean, basically, this so far year to date, it's up just below 200%,
It's
give
ridiculous,
or
isn't
take
it?
the odd percent. So,
Yeah.
and I'm looking at my comparison chart at the moment, and it's by far and away the best performing of the Magnificent Seven, closely followed by Meta Platforms, or
Hmm.
Facebook as it's well known, which is up about 60%, 60. So
Which is still
pretty good.
almost three times as much as the S&P.
Yeah,
Yet compared to Nvidia, you're kind of going, oh, yeah, that's not great.
yeah, indeed. Okay, so let's quickly look ahead, and it's not a particularly busy week next week. Got third quarter GDP out of the US, and PCE inflation.
Well, I
We've got
think
the latest
sorry
Fed
to jump
minutes.
in, the GDP is a revision anyway,
Yeah,
so that's even less
2.8.
important. Yeah, exactly.
We've got the latest PCE inflation numbers, which is the Federal Reserve's preferred measure of measuring inflation in the US economy. I think that's less important than the Fed minutes. I
Hmm.
think one of the things I took away from the September meeting was there was an awful lot of discussion, go to and forth about whether we're going to do 25 or 50. I don't think we're going to see that this time. I think there's pretty much uniformly 25.
Hmm.
Powell's poured a little bit of cold water on the idea that we can definitely expect 25 in December, which goes against your case for markets pricing in a definite rate cut in December. Weekly jobless claims again slowed.
Mm.
Continuing claims also lower. So why do they need a rate cut? Persuade me.
Well, the reason they need well, there's a number of reasons they need a rate cut. The first is because headline PCE is pretty much back at the 2% target, which is what the
Mm,
Fed are basing their policy on. The second reason is you look at the other side of the dual mandate, maximum employment. Um,
mm.
in order to ensure that those employment gains are protected, for want of a better word, you need to ease some degree of policy restriction. I think one of the, perhaps the best way to kind of frame policy, not just for the Fed, but globally, is we went to 5% because of an inflation emergency. The inflation emergency is now over, and we are back to, well, yeah, okay.
You sure about that?
For our listeners, Mr. Houston has just raised both of his eyebrows at me. I'm going to
Maybe
say
in the US. I'm not convinced about it here in the UK at all.
not here in the UK, definitely in the US, definitely in Europe. So if we assume that that inflation emergency is over, you don't need policy to be at an emergency setting. You can bring things back to a more normal level of rates, which is roughly neutral, which is roughly 3%.
What's neutral, Michael? Because it really depends. No one knows where
No one
neutral is.
knows.
And 4.75%, I would hardly call emergency settings.
Well, in the context of the last decade and a half.
Well, yeah, but we're not talking about the last decade and a half, are we? Because the last decade and a half, rates were negative or zero. That's emergency settings, if you want my opinion. We are now at normal interest rates pre-financial crisis. In fact, we're still below them pre-financial crisis.
We are below them. I don't think this is normal in the economy that we are in now. I think this is, significantly above. Most estimates have.
I got my savers hat on now.
Yeah, I'm sure you have. Most estimates of neutral are somewhere between 2 and 3.5%, depending on the economy. So you would argue that actually, when we're at zero, we're 200 basis points below neutral, and that's an emergency. We're now 200 basis points above. So why can't that be an emergency? Okay. It's all semantics, isn't it?
Well, it is semantics, isn't it? I mean, but at least we're disagreeing on something, which is good.
Indeed.
Because Richard said to me, "Disagree on something, will you?" So here
we are,
Richard, disagreeing. Okay,
that's your argument.
We also got mortgage approvals next week, UK mortgage approvals. So I think this will be interesting, given the recent rise in mortgage rates that we've seen pre and post budget. Whether or not, because when I was doing my written piece on mortgage approvals, 66,000 is the best number this year. I don't think we're going to go much higher than that. In fact, I will be very surprised if mortgage approvals next week don't come in lower.
Yeah, I can't imagine that we'll see much more of an increase. I mean, you look at swaps, we're probably about 40, if not 50 basis points off the lows now on both 2 and 5 year swaps. Put that in English, basically mortgage rates have gone up by about 0.5% since the lows that we saw 6 or 7 weeks ago, and that's naturally going to compress demand.
Yeah, and I'm looking at UK gilt yields at the moment, and they're not really that different to what they were last week. In the same way that when I look at stock markets this week, the FTSE is actually slightly higher than it was this time last week, so that's a good thing. Despite the fact
that's a rarity, isn't it?
It is. Despite the fact that we've seen profit warnings left, right, and centre. I'm looking at the FTSE 100. It's 81.28. And when we were speaking last week, I remember saying to you it's about 8,060. So we're 60 points higher. So that's good, right? If you want a tracker. Anyway, we're 48. Let's quickly wrap this up. Kingfisher, B&Q owner, that'll be interesting, given the collapse of Homebase that we talked about briefly last week. We've also got easyJet's full year numbers for this financial year. I'm trying to find my notes for that, and I can't find them anywhere.
Well,
I don't know what I've done with them.
Maybe someone's taken off with them.
Oh, Michael. If I had a red card right now, I would be showing it to you this very minute, because I'll tell you, that has got to be the worst one ever. Here we go. Found
there we go. We found it now.
So, airlines, particularly, I mean, easyJet normally has a first half loss, struggles to make any money in its first half. Second half of the year generally tends to make all of it back. Now, in Q3, they suggested that they might be able to make more than they made in profits this year. Given the fact they lost 350 million in the first half of this year, for me, I think that's a big ask. But I guess we'll see when they report on the 27th. Um, the sentiment towards easyJet has been a bit of an improvement in the last few months. They're at a 9-month low back in August. What's their bookings schedule looking like for the first quarter of next year? Um, I think it's a tough one because I think airlines tend to be very discretionary when it comes to consumer spending.
Mm-hmm.
easyJet Holidays is doing well, which is a good thing. I think that's one of the key factors that are helping to support the share price. But will it be enough? They're making a lot more money from ancillaries as well,
Mm.
obviously paying for teas and coffees and sandwiches on board. I have to say, when I go on easyJet, I never buy anything on board. I always take something with me.
Why would you?
Yeah,
I'm sorry.
I'm
I'm
not
not.
paying £5 for a coffee.
No, that's absolutely ridiculous to do that. But yeah, it is going to be interesting. And again, it kind of speaks to the health of the consumer more broadly. Are
Mm,
people feeling flush enough effectively to be spending on holidays and flights and, £20 gin and tonics when they're on board said flight? Time will tell.
yeah, and duty free. And then we got Kingfisher. Now, obviously, Kingfisher owns B&Q here in the UK, owns Castorama in France. In the first half of this year, total sales declined 1.4%, with like-for-like sales falling 2.4%. French business has been struggling for years. So I don't think we're going to be looking for any bright spots when it comes to the French business. The UK declined 0.2%, which actually was fairly good.
Hmm.
Screwfix is one of its standout operations, continues to blow out the lights, and that continues to support the UK business. And I think that will continue to do so. When they did report in the first half, they were optimistic about the outlook, saying they expected to see full year adjusted profit before tax coming between 510 million and 550 million. It'd be interesting to see whether or not they still think that,
Hmm.
given the last quarter.
Yes, indeed. That is going to be interesting, particularly, as you said, obviously there are a few sort of idiosyncratic issues with the home base one, but the
Mm.
sector does not appear to be in the rudest of health, so to speak. So it'll be interesting to see how well, I was going to say B&Q, but how Kingfisher are bearing up amongst that.
Well, B&Q, absolutely. B&Q Screwfix. Will they win some business as a result of obviously Homebase's
Hmm.
collapse? I think, there is a silver lining to that.
Yeah.
And their closest competitor is still probably going to be the Range.
Hmm.
And I've noticed that, particularly around here, there are a couple of Range outlets
Yeah.
growing up. So the
There
range
is.
does appear to be expanding. So there is I think there's a market there.
Hmm.
The bigger question is, can they take advantage of that market while maintaining their margins?
Yes, exactly that. And only time will tell on that front, I suppose.
Yeah, indeed. Okay, well that's it for I think this week. We've gone on probably a little bit longer than we normally do, but that's fine. As I say, any comments you've got, please drop them in the comments. Drop me a line at michael@goodmoneyguide.com. Hope you've enjoyed this podcast with me and Michael.
Hmm.
And we'll join you same time, same place next week when I think the US will be tucking into Turkey and pretty much anything else because the US will be closed for Thanksgiving.
Indeed. Are the Good Money Guide providing us with turkey next week, or are we going without?
Well, I'll see what Richard says when he watches the end of this video, shall we? Until
Please, sir.
next week, please, sir, can I have some more? Um, until next week, thanks for listening and yeah, see you next week.
Bye bye.
Cheers.